Hello again. This is Joe Davis, president of Stonebriar Wealth Management. Thank you for tuning in and continuing my 3-video series on how to avoid getting mauled by the bear market. In this video, I'd like to discuss the psychology of investing through market volatility.
Stonebriar Wealth Management, advisors for your life.
The real destruction in a multi-year bear market isn't necessarily the drop in portfolio valuations. It's the confidence that is lost among investors in the capability to weather the storm and come out stronger on the other side. History has shown that the market always recovers and eventually surpasses these valleys. However, it's the psychological damage that can be far more devastating. The one guiding truth to every cycle is that people are their own worst enemies when it comes to investing. The biggest risk to your money isn't a bear market, rising interest rates, the Federal Reserve, inflation, high-fee mutual funds, war, famine, or any other imaginable event. It's you, the investor. It's the emotional aspect of wealth management that can't be taught in a classroom or book. It's the rising fears you have that you aren't keeping up with the crowd when the market is rising. It's the terror you feel in the pit of your stomach when the stock market falls 20%. It's the fire hose of frightening headlines. Everyone preaches buy low and sell high, but it's not all that easy in practice with real money on the line. It feels awful the entire time you're doing it, and you never get the timing perfect either way. The best investors I've met over the course of my career never get too high or too low on the emotional spectrum. They always have a sense that things will ultimately work out. No one is perfect, no strategy is infallible. This level of stability and long-term commitment is what precedes a successful outcome. Investor versus trader. Inevitably, during a bear market, I always hear inquiries about making drastic changes in a portfolio in response to the market. Sometimes it's trying to actively time the market by shifting large portions to cash or finding pockets of stability in low volatility sectors like consumer staples or utilities. Some may even call for more drastic measures such as short ETFs or options to act as hedges. However, it's valuable to remind you and clients about the distinctions between being a strategic investor and a short-term trader. I consider an investor to be a participant in the market with an intermediate to long-term time horizon and a moderate level of risk tolerance. They are comfortable with modest swings in their portfolio given an appropriate mix of assets that works in harmony to achieve their goals. They don't swing for the fences, but instead take a balanced approach given their desire for growth or income. A bear market should not derail an investor from their chosen path, but rather reinforce their commitment to a steady, long-term compounding approach. They agree that the market whims can't be timed to perfection, and that protecting their nest egg is less about constant action and more about continuity of strategy. To an investor, doing nothing different may be the ultimate action step on their path to prosperity during a major correction. By contrast, a trader is more engaged in the ins and outs of their particular niche. They may day trade, swing trade, or otherwise attempt to time the market's machinations on a short-term basis to achieve profitable results. This often involves large cash positions, quick action, discipline, and a healthy understanding of risk dynamics. They can jump in or out of the market at a moment's notice, given their specific triggers or analysis, or a trader may be more inclined to take a short positions in a bear market, but that doesn't mean they're going to time their entries perfectly or always rack up profits. Bear markets can turn timing on its head, which makes it difficult for traders to cope with a new environment. They must constantly study the fickle nature of stocks to gain an edge in their process. And ultimately, the choice between investor and trader isn't a matter of which is better or can make you more money, Both roles have their own benefits and pitfalls, but staying in your lane may prove to be one of the most beneficial strategies to maintaining a healthy relationship with your money. And please stay tuned for my last video on specific tips on how to survive a bear market. Thank you.
Wealth Management, advisors for your life.
This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process described herein will be profitable. Investors may lose all of their investments. Past performance is not indicative of current or future performance. It is not a guarantee.